Hey everybody, Jeff Gibby here. Hope you're doing well. Let's go ahead and move this out of my way at least. Give me just a second here. All right. I want to welcome you all out to today's class. Thanks for coming. I hope you're doing well. Let's go ahead and kind of get to the legal disclaimer, shall we? Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy. Hey, Greg, I think, oh, here, let me turn off Greg's microphone.
Muted.
All right, that'll be a little bit better. He's getting a little bit of bleed back from his system. Anyway, today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So there you go. Let me go over and kind of just talk a little bit about our guest today. Is a gentleman by the name of Thomas Wood. Thomas does a really, really good job. He's going to talk a little bit about a patented methodology that they've designed to find when stocks are at fair value or undervalued or overvalued, and how they combine that with momentum to get really good trades. So without further ado, Thomas, let's get you on here. How are you doing today?
Hey, Jeff. I'm doing good. How are you doing?
Good, good. Welcome to today's class. I'm going to go ahead and turn the presenter over to you.
Alrighty.
I'll let you know as soon as we can see your screen. And welcome today. I hope, are you, tell us a little bit about your quarantine situation. Are you working in your basement? Are you in an unusual circumstance?
I have a home office anyway, so honestly, not much has really changed for me, thankfully, other than needing a real bad haircut.
Yeah. Well, I saw that problem yesterday. So.
Yeah, I'm about to.
All right. Well, it's all yours. And take it away.
Alrighty. Thanks, Jeff. As usual, it's a pleasure to be here working with Metastock. Always a pleasure to work with y'all. Today, we're going to be talking about value and momentum and trading with value and momentum specifically on the Metastock platform, because we got some really cool features that are available on Metastock and not on anything else. For those of you that are not familiar with my voice, like Jeff said, my name is Thomas Wood. I'm a partner at Basecamp Trading, also director of trading operations, but I'll go through and tell you a little bit more about myself here in just a minute. Before we get into the good stuff, though, I also want to go through a risk disclaimer. Just keep in mind, trading or investing carries a high level of risk and is not suitable for all persons. One thing I always tell people is, look, most traders, when they decide, I'm going to go start learning how to trade, they go and they open up an account, they put 20 grand in there, and they promptly lose 20 grand. It's always a better idea to learn how to trade first and then start trading. So I always encourage people, look, trade simulated first. If you can't make money with fake money, you're not going to make money with real money when your emotions are involved and everything. And then also only trade with risk capital, meaning only trade with money that it's okay if you lose it. Don't go mortgage your house or take your son or daughter's college fund and start trading with that, because that's going to put a ton of pressure on your shoulders where you can't mess up, and it's going to make it that much harder for you to trade without emotions. With that being said, we're also required to show you CFTC Rule 4.41, just a hypothetical disclaimer saying, look, past performance is not necessarily indicative of future results. Obviously, I wish I could show you examples from the future, but I cannot. So I'll be showing you examples from the past. Alrighty. So with that being said, I got a question for you. How are you doing with your trading right now? How are you doing with trading? You're going to be in one of three categories, unless you're not trading at all. And that's going to be either making money, losing money, or breaking even. So how are you doing? Making money, losing money, breaking even. Which category do you fall into? Making money, losing money, breaking even. Yeah, there's a couple things I typically look at when most traders, when they come in and they say, hey, Thomas, I'm losing money. Well, what do I do? And there's two big things that I look at first. First, they understand how to read price action and interpret price charts. And then the second thing is they understand how to trade with momentum and value. All right, because they go hand in hand with one another. And that's what we base 90% of our trading strategies on. All right. So with that being said, most traders out there have equity curves that look something like this. This is a guy that actually came in and and had a mentorship with me for a while. This was his equity curve beforehand. He left with a much better equity curve. But this was he had blown up an account, and this is what most people do. Most traders out there are just not very consistent. And one of the reasons is because they do not have proven rules to follow. And this causes real big extreme swings in their equity curves like this, where you're going from 520% gain, you drop all of a sudden 40%, rally again another 30%, and then go all the way down and lose everything. All right. And there's just a huge lack of consistency. All right. So when we're trading here at Basecamp, we follow proven rules and proven strategies. And these are the types of results we're after. And these are equity curves from people I've done one-on-ones with. This is Michael at the top, Dave in the middle, and Sherry at the bottom. And one thing you'll see, I want you to notice, is they're all very, very consistent. And that's what happens when you have a proven rule set to follow and base your trades on, and you're not just guessing at what you're doing. Because if it's not a proven rule set that's repeatable, then it's not going to be consistent over time. Okay, so with that being said, let me tell you a little bit more about me. This is me, Thomas Wood, my beautiful wife, Dora, and my 2 dogs. One thing that I always get told is, well, Thomas, if you're such a good trader, why are you teaching people? Why do you enjoy working in the industry and teaching people how to trade? And in order to understand why I'm so passionate about this, you need to know a little bit more about my background and why I got into it. So I've already spent more time in my life. The only thing I've ever done in my professional career is trade for myself, trade for others, run a fund, be a partner in a fund, and teach people how to trade. All right. And the whole reason I got started in the industry is my father, when I was a kid, like 12, 13 years old, started saying, hey, Thomas, this is one of the best ways to spend the time you want to spend with your family, make the best money, make the money you want to make, and actually be able to do the things you want to do in life. And he said, you don't want to be doing this backbreaking work that I'm doing. And he owned a construction company. Well, my dad ended up losing hundreds of thousands of dollars following these quote unquote gurus out there that really had no business, in my opinion, teaching anybody how to trade. And I thought, you know what, that's not right. And I wanted to become the exception to the rule and really show people what you can do with the proper education, proper tools, and proper strategies, and show them that, look, anybody can learn how to trade. I believe that with all my heart. You don't have to be some Ivy League educated individual that's super smart in order to consistently make money out of the markets. Right now, with that being said, this is Basecamp. So why Basecamp trading? Well, here at Basecamp, we have combined over 40 years experience in hedge funds and professional money management, as partners do. We're a trading technology and education company. We have patented trading tools that have been featured in Bloomberg, CNN Money, Barron's, Money Show, Traders Expo. I've done consulting with multi-billion-dollar funds, as well as worked with thousands of retail traders around the world. One of my most proud accomplishments is I can say I've helped somebody literally go from a retail trader that was consistently losing money to running their own bond hedge fund. Thought that was pretty neat, and she's done really, really well. But with that being said, our strategies work. All right, we are traders when it comes down to it. This is a broker statement from one of our funds in the past showing 4.7, just about 4.8 million in gains. On the current month, showing 7.6 million, just about 7.7 million year to date. This is an account I was trading on TradeStation, showing $30-some thousand in profits in a single day. And that being said, the strategies that we use, they don't only work with larger accounts. If you actually follow at Trades with Tom on Instagram, I just started that the other day. I'm doing like a challenge account. I took a $700 account in the past month and turned it into 3,350 or something, roughly, in about 21 days. So it's played out really, really well. So they work not just with large money, but with small money. Okay, so let's talk about what separates the professional traders from the 90% of traders out there that statistic we always hear, where they're losing money. They can't make any money. So there's a couple different things that professional traders or consistently profitable traders do a really good job of that most traders don't. One of the first ones is maximizing their profits. They do a really good job of making sure when they get into a trade, they allow that trade to run and make the money they're supposed to make. Okay. Many traders, most traders, retail traders out there, they end up leaving money on the table and they don't know how to maximize their profits. Okay. So how many of you look back at the trades you've taken in the past and you go, great, I made $500. I made $1,000. But if you would have left it on there for another 2 hours, you could have made $10,000. Happens all the time. So you have to have rules in place that help maximize your profitability. And one thing, by the way, that can help with this, I always talk about, most traders have kind of the wrong mindset when it comes to managing their emotions with trading. They kind of have it exactly backwards. So if you take nothing else out of this webinar, keep this in mind. Most traders are hopeful when they should be fearful, and fearful when they should be hopeful. What do I mean by that? They're fearful on their winning trades that they're going to give back the gains. So they see that unrealized gain and they're afraid to give that unrealized gain back. So they end up closing their trades out early. But then they're hopeful on their losing trades that it's going to turn. So they give it a little extra room, just a little bit more room, or they'll add to it just one more time. And they allow a small loss turn into a very large loss because they're hopeful at the wrong time and they're fearful at the wrong time. So you should turn that on its head, and you should be hopeful in your winning trades that they're going to continue to run, and you allow them to have the space they need to run to make the move that they need to make. But you should be fearful in your losing trades to cut those losers off quickly so that your reward risk stays very, very positive. All right. The second thing is confidence in approach. A lot of times I see retail traders, especially, they'll see a setup, they've learned it, and they go, I don't want to click that button. And they don't actually take the trade when it's time. And then they see the market move and it starts ripping their direction like it was supposed to off the setup that they saw. And they go, oh, shoot. And then all of a sudden they're trying to play catch up and they're trying to jump in and they end up getting in late. All right. And we don't want to do that because that comes from a lack of confidence in their trading strategy. All right. So keep that in mind. You have to have confidence in the strategy as well. All right, and then the third thing is consistency in gains. A lot of times I'll see retail traders and their equity curves are going like this. And that's what I was talking about earlier, where you don't have that system in place. You don't have those proven rules to follow. So you end up coming in and you'll do really well for a short period of time. Then you'll have a drastic downturn and then it'll start climbing back up and then have another huge swing to the downside. And that's because they don't have consistency in the types of strategies that they're trading. All right, so what are we going to be talking about today? Well, we're going to talk about the three components of trading, what they are, the three things we want to analyze before placing any buy or sell order. We're going to talk about understanding the fundamentals of objective value, what they are, what the value charts indicator is. We're going to talk about how to read the value charts indicator. And we're going to talk a little bit about value range trading and what that is, and combining price, value, and momentum. Okay, so today we're going to be covering this. And at the end of the presentation, you have a pretty good idea of whether or not, hey, you want to get the value charts indicator suite from Metastock. Great if you do. If you're not really interested in it, no big deal. All right, but hopefully you'll learn something from being here today. So with that being said, though, let's talk a little bit about the law of diminishing intent. And this applies to more than just trading. It applies to a lot of things in life. But we always start off with the best intentions, okay? But the longer we procrastinate and put off actually taking action, the more time that goes by, the lower the probability of us actually following through is going to be, and the less energy we're going to have to do it. So I would say, with that being said, I would say, look, if you decide, you know what, I need help with my trading, I need to fix this, I need to work on this, then take the step, take the leap, don't put it off. All righty. So let's talk a little bit about the three components of trading and what they are and how they work. So before we dive in with those, though, what's that first feeling that you get as a trader when you're about to place a trade? Because everybody has emotions that kick in, but what are they? Is it anxiety? Is it uncertainty? Hesitation? Maybe it's because you've experienced so much loss or pain or disappointment in the past because of the way you've been trading, you have fear and you're afraid to place those trades. Okay, well, when you understand how you're trading and why you're trading and the rules that are going into it, and you have confidence in the back testing and the way that the system was designed, that can help remove all of these emotions from your trading. All right, so the three components of placing a trade that we want to analyze, we want to look at the price. That's the number one. Okay, price is just the price chart itself. How's the market moving? How's the underlying moving? Are we trending up? Are we trending down? Are we in compression? Are we expanding? How's the market moving? The second thing we want to look at is momentum. And we can use momentum oscillators, things like the MQ momentum indicator or an MACD or stochastic. And that allows us to analyze that momentum component. And then the third thing we want to look at is value. And when I say value, I don't mean whether or not the market is extended one way or the other. What I'm talking about is objective valuation, not subjective value. Not, I think this is a good price to buy the stock because it's down 20 points off the high. One of my favorite quotes out there is just because don't buy a stock just because it's down off of its high. There always has to be a reason for it. And with the patented value charts indicators, we have a way of objectively valuing the market, kind of like when you look at Kelley Blue Book for your car and you say, okay, is this car a good value? Am I getting a good deal based on recent transaction history? That's what value charts are doing. They're telling us how good of a deal we're getting. And let me explain why this is so important. We actually had a hedge fund that we worked with that they had a system that they were running, and that system was losing on average $30,000 a month. All right. We ended up going in and we took the system, we added a value component to it. It was a price momentum based system. We added a value component to it. And that system turned around and went from an average of $30,000 a month loss to an average of $30,000 a month gain. So a complete 180-degree turn from where it was going just because we added that value component. All right, so let's talk a little bit about what value charts are and how they work and how we read them. All right, so value charts, what they do is they plot price in one of 5 value zones. Pretty easy, color coordinated. We have fair value, which is going to be the center green area. We have moderately over and undervalued, which is going to be upper and lower yellow areas. And then we have significantly over and undervalued, which are upper and lower red areas. So it'll look something like this on a chart. Now, you got to think of it kind of like a bell curve. So it kind of goes like this. All right. And over time, historically speaking, we trade significantly over and undervalued about 2% of the time. We trade moderately over and undervalued about 14% of the time. This is roughly, and then fair value about 68% of the time. All right. So keep that in mind. Normally markets trade in that fair value zone, but again, it's similar to a bell curve where the fair value zone is where the market's typically trading the most. And when we get to these extremes, that means there's a very high probability of it pulling back and going back into transitioning back into that fair value area. Now, with that being said, we actually took this and its patented tools. We patented the value charts algorithm, and we took it to 3 different PhD statisticians, and we had it vetted by Dr. Abraham Weiner at University of Pennsylvania, Wharton School of Business. We took it to Dr. Eric Laber from University of Michigan and Dr. Sheila Nair from UCLA. All right, and all PhDs were in agreement that value charts were highly effective in determining valuation and dramatically changing market environments. And one of the ways we do this is it actually adjusts based on volatility using what we call DVUs, or dynamic volatility units. So the algorithm will adjust how far a market has to travel to hit each of the value zones based on volatility and how the market has been moving. All right, so when we actually look at this on a chart, this is what it looks like on a MetaChart stock or MetaStock chart. So we have significantly overvalued at this upper red price bar segment. You can see the red dot appears just above it. So we know, for example, this little piece here is the very top edge of this bar. And we immediately the next day pull back down to fair value before jumping higher again. We hit significantly overvalued again, the upper half of this bar. Right after that, we pull sideways, market moves sideways until it gets back into fair value. It adjusts. Over here, we see significantly undervalued. Down here, immediately pops back up. Same thing here, significantly undervalued, immediately pop back up. Over here, significantly over and over, pull back the next day, pull back the next 3 days. Same thing over here, get a nice big pullback there. And what's really cool about it is we actually had, the way we set it up with MetaStock is that you can actually see it'll plot these dots above and below the price bars to show you just how far significantly over and undervalued it is. You can see, for example, when we got way up into significantly overvalued, that dot was larger than when we just barely poked up into it here. Same thing with moderately over and undervalued. So we can see just how far. So it's like, okay, building, building, building. And then you can see it kind of crest here and goes, we're really getting into overvalued here. and the market kind of stalls. So how do we use this? Well, this will help keep us, for example, from buying at the top of an extended move, buying here, and as soon as we get it, or selling there, as soon as we get in, it turns and pulls back the opposite direction. So it helps make sure that we're getting in an attractive value area, which in turn decreases the amount of time we spend underwater and allows us to decrease our stops. So we can use tighter stops, lower our risk, and also increase the amount of time we spend in the money and having the market move our direction much sooner. Make sense? Now, remember how I said we want to look at price, momentum, and value when we're placing a trade. Well, one of the first things we were going to talk about is understanding trend. Now, this is a price theory. This is how we trade price. But in order to determine a trend, we look at pivot highs and pivot lows. So if a price is going higher high and higher low pivots like this, we would say it's trending up. If a price is going lower high and lower low pivots like this, we say it's trending down. Anything else is going to be falling into a third category, which is consolidation / reversal. Well, once you understand how to identify trend, we can then filter our entries and say, okay, if we're in an uptrending market, that means all we're looking to do is buy undervalued retracements. If we're in a downtrending market, all we're looking to do is sell overvalued retracements. All right. And if we're trending higher, we would expect to see overvalued prices. That's good. That shows there's strength in the trend that is able to continue to push up into overvalued price points. If we're in a downtrending market environment, we would expect to see undervalued prices. That's good because it shows there's strength to the downtrend. All right, so when we look at this next chart here, this is Amazon, and this is on Metastock. We have the MQ momentum here, which we'll discuss here in a little bit, as well as value charts down at the bottom. And we can see that this market is very obviously trending higher. We have higher high, higher low pivots. Market is in an uptrend until we get over to the right-hand side. And in this right-hand area over here, we go into consolidation, ranging from these highs here, and these lows down here. We break out to the upside again. All right, but on the way up, if we know that, hey, this is trending higher, we can look to buy every time we get down undervalued. So that means we're getting in right there. We're going to get in on the low of this bar. We're going to get in on these undervalued dips. Every time we pull back into moderately undervalued, we can look to time our entry. Same thing over here. Moderately undervalued right there. Moderately undervalued and significantly undervalued actually right here. Moderately and significantly undervalued right there. Same thing here. So what we're doing is it's helping us time our entry into this trend where we have a very high probability of once we get in, it quickly starts to move back our direction so we don't have to spend a lot of time underwater. Making sense so far? You said, do the value charts use any company fundamentals? Nope, it's a fully technical indicator. Algorithm does not reference fundamentals at all. Okay, so let's talk a little bit about value range trading. Now remember, markets trend in three phases: uptrend, downtrend, consolidation / reversal. So when do we want to use range trading? Well, we want to use this when a market is in a consolidation phase. Okay, so value range trading is a great strategy to implement when you find a market that's actually in compression. Essentially, what we're looking to do is profit from market fluctuations between over and undervalued, because value charts, when we hit significantly over and undervalued, remember it's just a little over 2% of the time that we spend significantly over and undervalued. So when we hit those levels, those extremes, we know there's a very high probability that it's either going to stall, move sideways, or reverse and move back our direction. And if we're in a sideways trending market, that means once we hit those extremes, it's a very good mean reversion strategy. All right. Now you want to be careful though, attempting to trade value range trading, a mean reversion strategy during incorrect market conditions. We got to make sure that that market is trading inside of a range or it's in a consolidation based on price action. All right. So if the market is actually trending, then range trading does not work as well without implementing a directional bias. All right. Make sense? So let's take a look at a chart here. This is Tesla, and you can see we're pretty well-defined sideways market. So if we know we're in a sideways market, then what we can start doing is whenever we get these significantly overvalued pops, here, 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 for example, we can start to sell these significantly overvalued rallies. And when we get significantly undervalued, we can start to buy those undervalued sell-offs. Down here, we'll get significantly undervalued right there. Same thing here, because we know we have a very high probability of it moving back our direction rather quickly. Now, the thing about it with value charts is they actually are updating real time. So you can see this as it's moving. You'll see it transition from, for example, right now it's trading at this time, it was trading at fair value. We can see it transition to an extended level. It'll hit significantly undervalued. We then initiate our trade. So we're not even waiting for the bar to come to a close. A lot of times we're able to get in while it's in that extreme so that it pulls right back even on the same bar. Make for a very quick entry and exit within the context of a sideways moving market. Okay, and again, remember with trading, it's all a probabilities game. I mean, everything we do is based on statistics. We have a high probability with a set win rate and a set reward risk ratio. We know we'll come out net profitable with a large enough sample size, right? Well, with value range trading, that's exactly what we're doing. We're looking for that statistical edge that's going to increase our likelihood of getting into winning trades. Now we can take a look at another one. This is Alphabet or Google. You can see for a while here, we were in compression. We didn't have a trend. And then we come out of the compression, we start going higher highs and higher lows, right? So while we're in the compression phase over here in a circle, we're doing value range trading. We're buying significantly undervalued. We're selling significantly overvalued. Buying significantly undervalued. Selling significantly overvalued. And we're catching these nice little swings as the market chops around. Once we start trending though, and we start going higher high, higher low, then we're looking to only buy the undervalued dips. So we're buying here, we're buying here, we're buying here, we're buying here. And if we really want to get selective, we'll implement that directional bias, but then we'll also wait until it gets significantly undervalued. So that means we would only have bought right there on this price bar, right down here at the low, right before it turns and starts right back up our direction. Market then turns, goes into compression, and then we start going lower high, lower low. So we're looking to short again. We'd be selling here, here. We'd sell on this bounce here at overvalued. Once again, we'd sell here, overvalued. Then the market goes back into a chop because we go lower low and we go higher high. So that means we're going to implement range trading. We'll go significantly overvalued. So we'd sell at the high. We get significantly undervalued right over here. We buy right down there, right before the gap up the next day. And we'll go back into range trading until we go into an uptrending environment. Once again, then we'll implement directional bias. Making sense? Now, one of the really cool things that we've done with the Metastock platform is we actually added expert commentary to kind of help hold your hand and guide you along the way. So we've set up value charts to have expert commentary on current market development. So you can turn this on or off depending on whether or not you want it there. And this tool can help you with analyzing what's going on in the market and help you identify potential trade setups and market bias. So this will analyze value and momentum. In the section 1 here is broken into 3 sections. First section is going to tell you kind of the current bar information. Then the second section is going to tell you the value charts analysis. So is it a buy opportunity, sell opportunity? For example, it says this gives many traders sufficient reason to consider covering a short or taking a long entry, especially when similar signals exist in the same market across multiple time frames. All right, then this third section will give you considerations based on value charts. So buying considerations. Buying now would likely be at a fair value relative to its own price action. Selling now would likely be a fair value relative to its own price action. Hold considerations. Consider waiting for a price to move beyond fair value where a buy or sell bias will become evident. So it's saying right now, the market's just in fair value. We don't really want to do anything. All right, but it'll walk you through and help you with learning how to analyze the tools in the market, and it help you with kind of guiding you along the right paths on which way to be taking trades. All right, so with that being said, let's talk about that third component, adding momentum in there. So one of the things that we've done is when you purchase the Value Charts Indicator Suite for Metastock, we actually also give you access to the MQ Momentum Indicator. when you sign up for the add-on. So the momentum is a momentum oscillator that's used in determining kind of the strength of a market one way or the other. One way of using it is to identify bullish and bearish divergences, which is one of my favorite ways of using this tool. Now, this is what it looks like. It's just an oscillator down at the bottom. Looks similar to an MACD, but moves a little bit different. We have a couple of big things we want to pay attention to. The indicator lines, they tell us the trend of the momentum. And then the histograms kind of tell us the force of the move. So the deeper down these histograms go, for example, from there to there, that's a much stronger down move than the down move that took place right there. And this up move here is much stronger than this up move here, or a little bit stronger than this up move there. All right, so it kind of tells us the strength of the force behind each run or each swing that the market has. So with that being said, when we look at it on a price chart, we can combine price and momentum to determine divergences. Now, a divergence occurs when price and momentum are no longer moving with one another. So you can see here, for example, this is Apple. Lost my mouse there for a second. On the way down, while we're trending down here, we see momentum is also trending lower. All right, but then right here at the bottom, what do we see happen? Price goes up, back down, it hits a new low. So price goes to a lower low, but at the same time, our indicator line is higher between those 2 points, and our histograms are a lot stronger between those 2 points. So that's what's called a divergence, when price and momentum are no longer in agreement. And it tells us that this market is due for consolidation, at least. And if we can get through the pivot high up here, potentially a trend reversal. In this case, we get through the pivot high and it turns right back into an uptrend. And you can see momentum indicator lines confirming the uptrend all the way up. We continue to put in higher high and higher low indicator lines and histograms as this market continues to trend up. Okay, so we use it kind of as a confirmation tool alongside of our other analysis. Now, along the same lines, take a look. Here's another one. This is Alphabet, or Google once again. And we can also see when there's disproportionate moves between price, momentum, and value. So for example, right up here at the high, we got significantly overvalued, right? And then the second rally, we're significantly weaker on the indicator line. There's a disproportionate weakness on indicator line and histograms compared to price, because price was just about to the same highs, but momentum was significantly weaker. Value was also weaker. We couldn't even get back up to significantly overvalued again on that second rally. So now we have a price, momentum, and value divergence, which gives us a higher likelihood of success. Same thing on the way down. We can see each of these rallies as we sell off and then bounce and sell off and bounce. Our momentum indicator line continues to go lower highs and lower lows all the way down until we go into consolidation here. And what does the price do? Price consolidates as well. Okay, and on the way down, we can also see that each one of those rallies, there's no strength behind them because they're barely poking up into moderately overvalued, which is what we want to see in a downtrend. If we're in an uptrend, we want to see it barely poking into moderately undervalued. Make sense? And you can see on the way up, as we're trending higher, what's our momentum doing? Momentum is also trending up. Higher highs, higher lows on the indicator line. All right. Now, I know this sounds kind of complicated because there's a lot to take in, but we actually made it a lot simpler for you. And again, this is unique to Metastock, which makes why I like Metastock's version of this so much better than anything else. So another great way of combining or of using the ValueCharts indicator suite on Metastock is we actually went ahead and combined momentum and ValueCharts tools to call out potential entries for you. So we set up the Metastock version of ValueCharts to call out potential buy and sell signals that are generated when markets hit extended value levels, but the momentum is not there. So it looks at the price, it looks at the momentum, and it looks at the value to determine potential entries. And this is what it looks like when it's on your chart. This is IBM. You can see we have neutral bullish signal on the left, and then we go VC buy, market turns and starts to climb back up. We have a nice strong VC sell here, and you can see the divergence occurring on the momentum and the value, even though price was equally high. And we get a really nice sell off there. It goes right down to significantly undervalued, shown by the red dot, and then goes right back into consolidation, bounces overvalued, so we reinitiate a short again, right down again, significantly undervalued, the red dot, right back up it comes. Then we have a nice big VC buy signal here where we have strengthening momentum. and price breaks out of compression, get a nice pop for a few days. Then we get neutral bearish pressure showing up at the highs here. Market starts to turn, come down. We get neutral bullish showing up. Market goes sideways. Neutral bullish again. Market reverses. Bearish, come right back down. Rally, get significantly overvalued, shown by the red dots. Market reverses. Significantly undervalued, shown by the red dot. Pop right back up again. Once more, you go neutral bullish here, and then you get a nice VC buy signal right at the low, coming right back up until you get neutral bearish pressure, and it goes sideways. All right. So it works really, really well. And again, this just calls you out or calls out the signals for you, so you don't have to actually sit there and do all the analysis yourself. Here's another example. This is Tesla, that same Tesla chart. And you can see here, Tesla's moving sideways, but actually inside of this sideways, there's a lot of really good signals. We have VC buy right there for a long, neutral bearish pressure, we sell off, neutral bullish, we rally back up, VC sell signal. Once again, this is a really good divergence, high 1 to high 2. Then we have that lower high here. Same thing here, lower highs, sell off. Another nice VC sell signal. Right down we go till we start getting neutral bullish pressure. Market bounces back up. Then we get neutral bearish. It runs right through that. Neutral bullish bounces, neutral bearish, and moves sideways. Okay, making sense? So again, we've kind of added it all together. And then you can see at the bottom, we added this ribbon. So you can actually say, okay, I know I'm in bullish territory. So right now on the far right-hand side of the chart, we actually have a bullish bias intact or in place at that time. All right. So let me show you kind of what we do with Basecamp and some of the results. I told you I'd show you that lady that started her own bond fund after coming in and being a losing trader. So this is Randy's equity curve. He's done really, really well. He's very, very consistent. And again, he learned the principles of trading price, momentum, and value. That's the one thing all these people have in common. This right here is Lori's equity curve. This is the lady that started her own bond fund. She's done really, really well. Her equity curve is better than mine. And it doesn't get much better than that. This is Frederick's equity curve. His is beautiful. He's trading future spreads, but again, based on price, momentum, and value. This is Dave's. Dave was a friend of mine. He actually passed away, but his story is great because he said he'd never failed at anything in his life, but trading was vexing him because it seemed like the harder he tried, the worse he did. And then when he came in, he learned how to trade. He learned the proper way to analyze price, momentum, and value. He actually realized his goal of becoming a professional trader, meaning he was paying his bills by trading. He was averaging $3,000 a week or more. And he was doing a very, very good job. And you could see his equity curve is very, very consistent. All right, so I got a question for you. For those of you that are ready to maximize profitability, increase your consistency, and grow your confidence, those 3 big things that are important to becoming a consistently profitable trader. Here's the deal we have going on for you with Metastock tonight. If you go to metastock.com/ValueChartsA, or you call them at 1-800-882-3040, you can get the Metastock add-on for $9.97. Plus, we'll give you a bonus workshop on the Value Trading Bootcamp. This will teach you all about the different setups and strategies we use to implement value range trading and to implement value charts and momentum. Okay, it's a lifetime license, so it's a one-time fee, lifetime license for Metastock. So with that being said, if you have any questions, I'm more than happy to answer them. Yeah, again, it's fully technical indicator. It doesn't, so the question is, do value charts use any fundamental analysis in their algorithm? No, it doesn't pull any fundamentals for the companies. It's all based on price action and technicals. Jeff, do we have any questions over on YouTube at all?
I have to be able to find my mic button. Not a lot of questions. We do have quite a few people watching on YouTube. The one notable comment that we've got over here is great add-on, great presenter. So there you go. So you did a really good job. You did forget a few things that we'll throw in.
I apologize.
So I'm just going to leave this screen up because it does talk quite a bit about it. But in addition to this, it's obviously an add-on for Metastock. So it does require Metastock. If you don't have a copy of that, well, actually, as part of that $9.97 price, we'll give you a free month of Metastock real time with the data region of your choice, with one of the premium news services, our Metastock Zenith platform, and that'll all come included with that. We also back it with a unconditional 30-day money-back guarantee, so you can try it. You can agree with Scott that it's a great add-on, and if you don't agree, you can get a refund. So we back all of the products we sell with a money-back guarantee. We like to give you a pretty good risk-reward ratio. So if you have questions or if you need some help getting that set up, just give us a call. It's 800-882-3040. You're going to get ValueCharts. You're going to get the real-time version of Metastock with the real-time news service. The data in that is delayed unless you pay the exchange fees. There's some exchange fees. It's not very much per stocks. It's like a couple bucks for each exchange. If you want futures, it can be more expensive though. So it's best to give us a call, 800-882-3040. Or if 15 minutes is okay for you, you can actually just do it that way as well. You can also chat online with our guys at metastock.com/sales-chart. Sales chat, not sales chart. I have something else on my mind. Robert does have a question for you. Are you still, if you're still there? He says, what time frames do you prefer most to use this system on?
I like using dailies and 240-minute price charts. And then if you're day trading, the main thing I trade honestly is futures. And for day trading with futures, 30-minute price charts do a really, really good job of telling us when a market gets extended on a run and to start taking profits.
Out of pure curiosity, Tom, what futures markets do you like to trade?
The indices, bonds, gold, oil, and euro are the main ones I trade.
Okay. Awesome.
I also trade, when I say oil, I should really say crude oil and RBOB because I trade the crack spread a whole lot.
Do you have any quick comments about yesterday's or Monday's crude oil situation?
If you were in the trading room with me, we made a whole bunch of money because 2 weeks ago we had a very unique spread set up in the crude oil gas spread, it's crack spread, where you sell crude oil and you buy gasoline because for about 2 days there, crude oil was actually more expensive than gasoline, which if you understand how that works, gas is derived from crude. So there's a cost to that refinement process. So it was a really, really good opportunity. It doesn't show up often. Every few years it'll happen. And you sell crude, you buy gas. Doesn't matter which way the market goes, you're hedged. And that actually ended up making about $60,000 per spread when crude tanked.
Dennis asked a question in YouTube that I can't really, we really just aren't prepared to answer. He's using one of the built-in systems in Metastock called our PS3 percent crossover system. It's a really, really good system. He wants to know how that compares to the ValueCharts add-on. And Dennis, that's a really, really good question. What I would probably recommend is just get in touch with us. Give us a call, 800-882-3040. We'd be happy to pull charts for you, send you the results of the system, let you kind of take a look at it and see if it's something that you should take a look at or something that you like. And again, yeah, that number is 800-882-3040. So Tom, any final thoughts?
Oh yeah, there's a couple other questions. Rob, you asked, are these for options trading only? No, it's not for options only. Like I said, I primarily trade futures, but I trade futures, Forex options, and equities. But again, futures my go-to. But you can use it for all of the above.
And so for options, you're really kind of looking at a direction on a stock.
Yeah.
And then you decide whether you want to buy a put or a call or something like that. Okay. Do you generally have recommendations for like delta and expiration when you're looking at those?
No, that really depends on account size. So for example, that account I was telling you, I did that $700 challenge account. That was all options trading. I did it all off my cell phone on Robinhood. But with that being said, when I was doing that, I was actually basing the options I was trading based on value charts and the direction that I believe the market was going, and then the amount I could actually afford because premiums were so high due to volatility. So
you have more questions coming in through YouTube too, or through GoToWebinar too. So does it work for day trading?
Yes, absolutely works for day trading.
Go ahead. I'll let you take that one.
I was going to say, what does the S&P futures chart indicate for the 23rd of April trade open? I don't have MetaStock pulled up on this computer right now. I apologize. I can't pull it up. Not on any trading platforms at the moment.
Yeah, Mohammed, give us a call. 800-882-3040. We'll send you a chart. We'll show you exactly what it looks like. Philip from YouTube asks, is value charts based on a standard deviation?
That's a very oversimplified way of saying it, but yeah.
Okay. Very good. That's all I got. We've exhausted the questions. Tom, good job today.
I appreciate it. Thanks for having me on.
If you guys want to try it out, again, risk-free with our money-back guarantee, 800-882-3040. This thing has been such a popular add-on since we brought it on. I'd encourage you to give it a try. Above all, I want to say thanks to Thomas for coming. I want to say thanks for you guys for coming. I hope it was worthwhile for you. Stay safe, stay healthy, and we'll see you at the next one.
Alrighty, see you guys.